studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
Now that we understand why the Capital Dividend Account exists, let's learn how it is built. A simple way to think about the CDA is as a special tax-free bucket inside the corporation. It's important to understand that the CDA is not a bank account, and it does not hold actual cash. Instead, it is a tax tracking account that records certain amounts that may eventually be distributed to shareholders as tax-free capital dividends. Every time the corporation receives a qualifying tax-free amount, that amount flows into the CDA and increases the balance. The most common source is the non-taxable portion of capital gains. For example, when a corporation earns a capital gain, only part of that gain is taxable. The non-taxable portion is added to the CDA and becomes available for future tax-free distribution. Another important source is capital dividends received from other corporations. When a corporation receives a capital dividend from a subsidiary or another Canadian corporation, that tax-free amount generally flows into its own CDA. The CDA can also increase when a corporation receives life insurance proceeds. In many situations, the death benefit received, net of certain adjustments, creates a significant addition to the CDA. Finally, certain trust distributions related to capital gains can also increase the account. When a trust allocates qualifying capital gains to a corporate beneficiary, the non-taxable portion may flow into the corporation CDA. The key idea is that all of these transactions share one common characteristic. They represent amounts that have already received favorable tax treatment and therefore may eventually be distributed to shareholders without creating another layer of tax. Think of all these transactions as pipes filling the CDA bucket. As more qualifying tax-free amounts enter the corporation, the bucket fills up and the CDA balance grows. And the larger the CDA balance becomes, the more tax-free capital dividends the corporation may potentially pay in the future. In the next slide, we'll look at the opposite side of the equation and see which transactions reduce or drain the capital dividend account. In the previous slide, we learned about the transactions that fill the capital dividend account. Now let's look at the opposite side of the equation. Not every transaction increases the CDA. Some transactions actually reduce the balance and drain the bucket. There are two major reductions that every tax preparer should remember. The first is the non-deductible portion of capital losses. When a corporation realizes a capital loss, the CDA does not ignore that loss. Instead, the non-deductible portion reduces the CDA balance. Think of it as tax-free value leaving the system. This rule exists to maintain fairness. Otherwise, corporations could continuously add gains to the CDA while ignoring losses, which would overstate the amount available for tax-free distributions. For example, suppose the corporation realizes a capital loss of $20,000. The non-deductible portion is $10,000. That $10,000 amount reduces the CDA balance. The second major reduction is capital dividends paid. Remember, the CDA exists to track amounts that may be distributed tax-free to shareholders. Once a corporation actually pays a capital dividend, that amount is no longer available. As a result, the CDA balance must decrease. For example, imagine a corporation has a CDA balance of $120,000. If it pays a capital dividend of $40,000, the remaining CDA balance becomes $80,000. A very important rule is that the same CDA balance cannot be distributed twice. Once a capital dividend is paid, that portion of the CDA has been used and must be removed from the account. This is why capital dividends act like money leaving the bucket. At this point, we can start to see the complete picture. Non-taxable portions of capital gains fill the bucket. Capital dividends received from other corporations also fill the bucket. But non-deductible portions of capital losses drain the bucket. And capital dividends paid drain the bucket as well. A simple memory rule is this: gains and tax-free additions increase the CDA. Losses and capital dividends paid decrease the CDA. In the next slide, we'll bring everything together and see the complete CDA formula, including how additions and reductions combine to determine the final CDA balance available for future tax-free capital dividends. Now that we've seen what increases the capital dividend account and what decreases it, we can bring everything together into one simple formula. At its core, the CDA calculation is straightforward. The CDA balance equals all additions minus all reductions. Think of it like a bucket. Every qualifying tax-free amount fills the bucket. Every reduction drains the bucket. And whatever remains is the amount that may potentially be distributed to shareholders as a tax-free capital dividend. Let's start with the additions. The CDA generally increases from 4 major sources. First, the non-taxable portion of capital gains. Second, capital dividends received from other corporations. Third, certain life insurance proceeds. And fourth, certain trust allocations related to capital gains. These transactions add tax-free value to the account and increase the balance available for future capital dividend planning. Now let's look at the reductions. The CDA generally decreases from 2 major sources. The first is the non-deductible portion of capital losses. The second is capital dividends that have already been paid to shareholders. These reductions ensure that the CDA accurately reflects the remaining tax-free amount available inside the corporation. Let's walk through the examples shown on this slide. The corporation realizes a capital gain of $150,000. Since only the non-taxable portion affects the CDA, $75,000 is added. Next, the corporation receives a capital dividend of $25,000 from another corporation. That amount is also added to the CDA. Later, the corporation realizes a capital loss. The non-deductible portion of that loss is $10,000, which reduces the CDA. Finally, the corporation pays a capital dividend of $30,000 to its shareholder. That payment also reduces the CDA balance. Putting everything together, we start at 0. Add $75,000. Add $25,000. Subtract $10,000. Subtract $30,000. The result is a final CDA balance of $60,000. And that $60,000 represents the maximum amount that can potentially be distributed as a tax-free capital dividend. As a tax preparer, there are a few key questions you should always ask when calculating a CDA balance. Did the corporation realize any capital gains? Did it realize any capital losses? Did it receive any capital dividends? Were there any life insurance proceeds? Were there any trust allocations? And were any capital dividends paid during the year? By answering these questions, you'll identify most of the transactions that affect the capital dividend account. The key takeaway is simple. The CDA is not a complicated mystery account. It is a running balance. Add qualifying tax-free amounts. Subtract the required reductions. And the remaining balance represents the corporation's available tax-free capital dividend capacity.